One thing that sort of worries us a little bit, so what we sort of get is the consumer's doing a bit better, but they're still conservative and they're buying services, not goods. The apartment market is really very strong. One of the big problems is non-mining investment. So I've told you so far that the Australian economy is looking better. When you ask the same businesses, what do you think you're going to do in the next 12 months? Black is basically mining, and so it goes from 100 billion to 40 billion. The red, which is non-mining, you would hope goes up to help fill in the hole. If you look at the last sort of observation here in the two red ones, you've actually got non-mining investment going down. So there's sort of this disconnect between when you ask businesses, what are you doing now, vis-a-vis what are you going to do in 12 months' time? Now, we're not sure. I'm hoping the businesses is basically overly pessimistic. There are a couple of reasons why it might not be the case that they're overly pessimistic, and two of them go something like this. The left-hand side there is capacity utilisation. So the little dots are basically where the current level is, and the line across is the long-run average. So there's a lot of industries that basically have lower than average levels of capacity utilisation. In other words, the economy picks up, you're running your machine a bit harder, rather than investing more. The other thing that we've done, albeit with the Reserve Bank, is ask people what rate of return do you need before you'll go and invest, which is on the right hand, which is, as you look at it on the right-hand side. On average, they say 13%, which we think is pretty high. So maybe you're not actually going to get that. So maybe it's going to take you 12 months to realise you're not going to get a 13. Because in a real rate of return, that's huge. That's over 10%. And I can understand why the miners want 20%, but the rest of them are pretty high. So where we sort of end up when we sort of bring it all together goes something like this. We have GDP in red, 2 3/4, 3%. And so the argument I've heard a lot about is, oh, the economy is actually going to fall over, etc., in terms of GDP. It ain't. Or put it a different way. For it to fall over, you need the domestic part of the economy to go at -2, because exports are going to be +2. The problem really becomes more about the blue line, which is domestic demand. And domestic demand for us looks still quite weak. The only encouraging thing that I can say is there's some reason that we think the statistician is currently underestimating essentially what I might call domestic demand in the non-mining sector. So if in the non-mining sector is doing better and the mining sector is actually doing worse, then actually the employment part of the economy is probably going to be better. And that's sort of the story why we think employment might be better. If I put up a chart, we use our business survey, which is heavily driven out of the non-mining sector. What we get is a pretty close correlation, but just at present, what we're seeing is the non-mining domestic demand is more like 3 in growth rates. So what we're saying is part of the story about strong employment growth when everyone's been surprised is the non-mining sector is actually doing better than people think it is. And the mining sector that doesn't employ very many people now is doing less.